Welcome to Asset Zenith. Take a deep breath, settle in, and let's explore one of the most important, yet often misunderstood principles of long-term investing: the art of portfolio diversification. This isn't just about numbers or financial jargon. This is about protecting your future, maximizing your potential, and building a life of confidence and stability through smarter decisions. So, let me tell you a story. Not long ago, there were two friends, Alex and Jordan. Both had been saving for years and decided it was finally time to start investing. They had similar goals: financial freedom, early retirement, and maybe even traveling the world someday. But their approaches couldn't have been more different. Alex was bold. He believed in going all in. He'd been reading about a fast-growing tech company, sleek, innovative, and already making headlines. Without hesitation, he poured nearly all his savings into it. "Why diversify?" Alex said. "I've done my research. This company is the future." Jordan, on the other hand, was thoughtful. She had also read about that same tech company, and yes, it sounded promising, but she remembered something her grandfather once told her. "Never put all your eggs in one basket, especially when the basket is floating in the wind." So Jordan spread her investments out. A portion went into US stocks, some into international funds. She added a slice of real estate through a REIT and even set aside a small chunk for gold. She bought some bonds, not the most exciting thing in the world, but solid, dependable. Months passed. The tech sector soared. Alex's confidence grew. His investment tripled. He looked at Jordan's portfolio and laughed. "You're missing out," he said. But then, just as quickly, everything changed. A wave of new regulations hit the tech world. The company Alex had invested in plummeted. Bad earnings, internal scandal, panic selling. In a matter of weeks, he lost over 40% of his portfolio. Jordan, meanwhile, did take a hit in her tech investments, but her bonds stayed steady. Her gold actually rose. Her international holdings balanced the drop. While Alex was scrambling to rethink his future, Jordan was calm. Her diversified approach had softened the blow. This is the power of diversification. It's not a fancy trick or a complex theory. It's a mindset. Let's talk about what it really means. Diversification is the simple act of spreading your investments across a variety of assets so that no single event, no single crash or surprise can derail your progress. Think of your portfolio like a well-balanced meal. You wouldn't eat only dessert every day, right? You'd mix in proteins, vegetables, grains, not just for nutrition, but to avoid harm. In investing, the same rule applies. You can diversify in several ways. First, by asset class, investing in a mix of stocks, bonds, real estate, cash, or commodities. Second, by industry or sector: technology, healthcare, finance, energy, consumer goods, and so on. Third, by geography, balancing investments between domestic markets and those abroad. And finally, by style, mixing value and growth, small cap and large cap, active and passive strategies. When done thoughtfully, diversification allows different parts of your portfolio to respond in different ways to the same event. While one part may dip, another may rise, creating a balancing effect that reduces overall volatility. But why does this matter so much? Why not just chase the hottest stock and ride the wave? Because the market is unpredictable. No one, not even the best fund managers in the world, can consistently predict what will happen next. And if you place all your bets on a single idea, you're not investing, you're gambling. Diversification is your insurance. It won't make you rich overnight, but it will help you stay in the game longer. It protects you from sudden losses and gives your investments a chance to grow consistently over time. So how do you build a diversified portfolio in real life? It starts with knowing yourself, your goals, your time horizon, and most importantly, your risk tolerance. Are you comfortable with short-term losses if it means bigger gains later? Or do you prefer stability, even if the returns are more modest? Once you've identified your comfort zone, begin with your core asset allocation. A young investor with decades ahead might go with 70% stocks, 20% bonds, and 10% in alternatives like real estate or gold. Someone closer to retirement might flip that balance to prioritize safety. Next, diversify within those assets. Don't just buy any stocks, mix it up. US and international, large and small companies, different sectors. For bonds, combine government bonds, corporate bonds, and municipal bonds with varying durations. And don't forget about non-correlated assets, things like real estate, commodities, or even crypto in small strategic amounts. These assets don't move in sync with traditional markets and can be a valuable buffer. You don't have to do this alone either. Index funds and ETFs are excellent tools. A single ETF can give you exposure to hundreds, even thousands, of securities in one move, offering instant diversification at a low cost. And remember, markets shift over time. Your portfolio today won't look the same in 5 years, nor should it. That's why rebalancing is crucial. Let's say your stocks perform really well and now make up 80% of your portfolio. That means you're exposed to more risk than you originally intended. Rebalancing brings your investments back to your intended allocation. It's a quiet discipline, but one that pays off in the long run. Now let's pause and reflect. Are you more like Alex or Jordan? Do you know how your current portfolio would react if the market dropped tomorrow? Have you unintentionally bet too much on a single sector, country, or asset? It's okay if you have. Many investors do at some point. The key is awareness and the willingness to adjust. And here's something else. Beware of over-diversification. Yes, you heard that right. You can overdo it. If you own 50 different funds, but they all hold the same stocks, you're not truly diversified. You're just spread thin and paying more in fees than you should. The goal is not to own everything, but to own the right mix of things that balance and complement each other. Also, be cautious of home bias, the tendency to invest only in your own country. The global market is full of opportunities. Don't miss out just because something feels more familiar. Another pitfall? Chasing trends. Maybe you've heard friends talking about biotech, AI, or clean energy. They're booming, right? So you buy in at the peak, and then watch the hype fade. A diversified investor doesn't chase. They allocate with strategy. And above all, don't fall into the trap of set it and forget it. Diversification is not a one-time move. It's an ongoing conversation between you and your financial future. In the end, investing isn't about finding the next big thing. It's about staying in the game. It's about consistency over intensity. It's about building wealth not just for the highs, but for the inevitable lows. It's about sleeping well at night, knowing that you've built a fortress, not a house of cards. So, wherever you are in your financial journey, whether you're just starting out or managing a sizable portfolio, take a moment to ask, is my portfolio diversified in a way that truly protects me? Is it aligned with my goals, my risk, my timeline? If the answer is no, that's not a reason to panic. It's an invitation to grow, to realign, to build smarter. Because your portfolio should work for you, in good times, in tough times, and every moment in between. Thank you for joining us here at Asset Zenith. If you found this story valuable, if it made you think or inspired a new action, we'd love for you to like, subscribe, and share it with someone who's walking the same path. Until next time, stay curious, stay balanced, and as always, keep reaching for your financial zenith. Take care.